discussing the financial options for a single mother in terms of her Pretoria flat. The analysis discussed is from the time when the owner starts doing renovations, and it assumes that her salary and tax period run from September 2018 as period 1. The first element of the analysis is financing, as it is required in all other sections. To analyze the credit card and personal loan option, simple online calculators are used. Both options are analyzed over the 5-year planning period. A personal loan will incur 21% per year, and as well as an initiation fee and service fee. The credit card is based off a 20% interest rate, and it is assumed she already has a credit card. She can get good rates on both of these as she has an assumed good credit rating. Both of these have been calculated over fairly long periods as compared to the size of the loan. Shorter periods, however, result in the monthly payments becoming higher as she has no savings. She may not be able to afford them. Due to the lack of fees and the lower interest rate, a credit card will be the option between the two. A major difference between refinancing and getting a loan or using a credit card is that the interest payments on personal loans and credit cards are not tax deductible. The initial finance comparison is based just on the extra loan amount, excluding the 400,000 Rand. Prime is currently at 10%, so the interest rate used is 10.75%. The figures are calculated for 20 years, but only 5 years are presented here. As shown, despite the fact that the interest is paid over a far longer time, the interest payments are much lower, and even the total payments of over 20 years are cheaper than all of the other interests. It is, however, important to consider the total cost of refinancing. Using Excel's inbuilt amortization schedules, a schedule for the current and the remortgage loan have been built. These mortgage figures are from various sections of the schedules. They show that despite tax breaks to the deductible bond, the increased interest over the lifespan of financing causes it to cost more than if a personal loan or credit card were used. Having the lowest repayments and therefore interest, the credit card is there the chosen option. Because of this, no loan repayments are included in cash flows as credit cards aren't tax deductible. The first option discussed is option 1. In order to analyze option 1's decisions, we need to discuss laminate flooring and rental increases. This 5% increase decision was made off the norm of 3 to 5% for ongoing tenants. A rental decision to get a new tenant rather than keep the old one is, however, made because the increased rental income over a 5-year period is significantly higher. There is a risk of getting a bad tenant, but the 5% increase will barely keep up with inflation and will not make rental worth it. The laminate flooring decision is based off using a credit card and implementing the 8% rental increase per annum. The rental increase is applied to the first year and then an extra 800 Rand added per month from there. The laminate floor is financially feasible and so will be the considered option. To determine expenses for option 1, research was done for the ABEL rental agency cost, maintenance and cleaning. The cleaning has a cost of 5% per annum. The plumbing and painting are included as total operating costs but are not included in the taxable operating expenses as they were purchased using a credit card. The rates and taxes increase based off the averages of the data given. They are increasing much higher than rental income and could potentially eat into the income. Extra information included is the expected increase of property value as well as the rental income, including the 800 Rand increase. The 2% property increase is quite conservative, but due to South Africa's current property market, that's acceptable. The incomes are rental and personal income, and the laminate floor and oven are considered as the equipment that are depreciated. A decision to have the oven as being replaced initially was made, as there was no point letting it get worse and worse, especially if a tenant needed to use it. Depreciation for the stove is over 5 years, and the laminate flooring is over 27.5 years, which is the depreciation period for a house. The remaining book value of the laminate flooring is added to the selling price at the end of the 5-year period. Taxable income removes capital gains in the final year. The tax is paid in the 41% bracket. The cash flows include the principal mortgage amount and credit card payments, as well as loan and sale of property. The property is sold for the estimated value calculated earlier, plus the book value of the laminate flooring. Bond fees are researched with a yearly 5% escalation and agent fees of 5% of the sale. Capital gains tax was calculated using an online calculator, and an example of this is in option 3. Option 2 involves renting out a property on Airbnb. The site AirDNA was used